Episode 3 of But Up, Get Your Dollars Up. Episode 3, everybody. And I've got a good one for you. I spent some time to make some annotations because people have been asking for some graphs and visuals. I will give it to you. Ask and you shall receive, people. So we're going to go over the history of this whole trade so far kind of quickly. And then I'm going to give you current results. But then the most important part about today is what is the next move? How do I decide what my next move is going to be? Nobody shows me the answer. I have to figure it out. So what's the process? How do I do that? So I'm going to teach you how to fish. That's exciting. So here we are. History of what's going on. So I've got some annotations here. You may want to pause this part just to absorb what's going on and really see and evaluate. Maybe this is not 100% to scale. This is approximate, but yeah, I think you're going to get the idea here. So the put was exercised onto me, so I had to buy the stock at 120, but I got a premium for it, so my break even. So this put is in red. My break even and all these bars in the blue here are my break evens. So over time, that's gone down because I've been selling these premiums. I've been selling these calls at different strike prices. So on this week here, Apple had gone down. At the beginning of the week, I entered the trade. I entered the covered call here, not knowing where the stock would go, right? So it's going to go down, is it going to go up? Well, I figured, okay, I want to sell a little bit out of the money, get a premium. And sure enough, stock went down, and I sold calls again. And this one here, the market started to come back up, and I thought, okay, maybe there's some legs to this. And so I wanted a little bit of a higher strike price so that if it ran up more, so if it did a little bit more of this action, then I can participate a little bit more in that, okay? Meanwhile, my break-even price is going down and down. And this latest week here, on last Friday, I had sold the call for 121, strike price of 121, and essentially, market was flat. Apple didn't do a whole lot. There were a couple things that the market didn't like, I guess, and market wasn't very happy itself anyway. But my break even continued to go down. So again, pause this if you need it. But this is the put. This is my break even. These are the calls that I'm selling in the strike prices. Okay. Now we need to look at what do we do now? Okay. So this was when I was trading. I didn't trade at the end of the day, which is why I'm not showing you the price and options chain at the end of the day. This was kind of late morning here on the West Coast, and this was on the 20th. And so I'd closed out of my older position. It really wasn't worth much. And so I got to buy that out and basically keep the difference. But anyway, I'm now looking at this next week. What do I do for this next week? These are the strike prices. This is the last transaction price. This is the bid and ask. And so we're really only going to be interested in this grouping right here. 118 to maybe 123, 124. Okay. So we need to ask some good questions to be able to arrive at good answers. That's my whole theory. Okay. And I want you to look at this and pause the video. Actually do it. I really recommend doing this. Pause the video right now. Oh, well, not right now, but after you ask this question. What kind of question should I ask? I have 3. I'm going to share with you 3 questions that I ask. So you can pause it now. I'll give you an opportunity. All right. Hopefully you've paused and you've thought about it. Do you have your questions written down? Let's compare your answers to mine. Okay. So I have this analysis that I do. Not all the time. Sometimes I get lazy. I kind of know what this all pans out to be in my head. But this will be easier for someone who has not done it this way before. I created this. I don't know if anyone else does this. I do it. So here we have the strike price. The current price, 118.3. I just took the data from that previous slide that we just saw. Then we have all the strike prices, all the premiums. And so the questions I'm asking is, how much am I being rewarded by selling these premiums? And what is my maximum gain that I'm going to get as a combination of how much it's out of the money and how much I receive in premium. Okay, because if it's at 118 and I sell a call for 119, I get a premium of 141. Pretty good. And I talked about standardizing earlier. So it's really important to standardize, because what does 1.19% mean? Not a whole lot to me. What does 0.85% mean? Not a whole lot to me, because that's not a scale I work on. What I work on is the annual figure. Okay, so since these are weekly options, I just multiply by 52. And then you have this annual figure. Great. Well, okay, I'm going to get rewarded an annualized amount of about 61% if I sell this particular premium here. But the flip side is that I have to give up anything that's beyond this amount of growth. This amount of growth here. So if the stock goes up an average of 27% or more, I am likely going to miss out on everything that's beyond that. So then my total gain between the two, between the premium and the out of the money portion, is 89%. That's okay. That's not bad. But then you got to look at all of these, right? What am I getting rewarded? What's this maximum gain I'm going to have before I give the right for someone else to participate in that gain? And then therefore, what is my maximum gain? These are like, this is absolute maximum. This is pretty much never going to happen unless all of the strikes at the end of each week are just perfectly right at just where it is, and then you get everything correct. Okay, so I mean, this is really optimistic, let's just say. So after reviewing this data, and these are the graphs down here. This is the maximum annual gain in the orange. This is the out of the money annualized amount. And this is the premium. Okay, the premium that I'm receiving at each respective strike price. What is the annualized return that I'm getting? Okay, so with all of this data, this is another opportunity to pause and to consider, what would you do? What would you do? So let's pause it. Okay. All right, we back? Hope so. So how do I make a decision based on this data? Well, I've previously stated that my goal is to only have 50% participation on the downside. How do I make that happen? Through these call options and premiums that I'm receiving. Well, we can see here that I'm receiving a premium, a percentage premium equal to the price, right? And so what's the worst that can happen? Apple goes bust in 1 year. I think that's the worst that can happen. Extremely, extremely unlikely, right? Maybe they lose 50%, much more likely. But if I receive premiums equal to or close to 50%, then I am covering the worst case scenario really, really well, right? And so I chose this one here. I chose the strike price of 120 because it's giving me the annual premium, annualized premium worth about 44%. Why didn't I go a strike price higher? You might ask, because then, well, what about you're missing out on all this, right? This is a difference of like 40%. You can have 40% more in gains if the stock goes up. But that right there is the issue, if the stock goes up, right? And I don't know. I'm kind of skeptical about what's happening in the world right now. We have a couple bumps in the road that we'll likely continue to experience. And so I'm hedging a bit. I'd rather have a little bit more insurance and go in this direction. But if I felt really good about the market, really good about the stock in the next couple of weeks and months, then I might be higher on this side. But like I said, I ended up here. And I'm really doing a good job of achieving close to 50% limitation on the downside protection, and then on the maximum upside, I can potentially double, right? I can go up 115% in 1 year. This would require the stock to go up an even amount of roughly 71% per week. Again, these are optimistic because nothing goes up and down perfectly every week, but that's how I make my choice, right? I compare this data and I look at it and I see where my comfort zone is. How much premium do I want to receive? And what is the maximum gain that I'm willing to have for myself before it has to go to someone else, because I'm selling that right. I'm selling the right for someone else to buy it from me. So I am determining what it is that my limitations are. Okay. So that was my move. I sold this, lowered my break even down to about 112, and we'll see where that takes us into this next week here. But that's it for Get Your Dollars Up episode 3. Let me know your comments. If I'm trying to make this thing a little bit better, it's good to get feedback. So appreciate those who do give that to me. And I will catch you on the next one, everybody. Bye-bye.